Welcome to the sixth episode of Investing Sense. Earlier, I have rarely invested in banks. The reason is the difficulty to analyze the banks. Bank valuation are different from normal stock valuation. But while looking for the next set of candidates for profit in next 6 months, I have realized that most of the small cap stocks had a bull run with 60 to 70% increase in prices. So there is no opportunity available there. Then I have come across this data point which stated that HDFC Bank is currently at its lowest price to book ratio. The interest in HDFC Bank have led me to do analysis of entire banking sector to find out which banking stocks are the ones with potential upside. Banking Nifty has underperformed Sensex. Sensex had a return of 18% in last 1 year, whereas Bank Nifty had returns of around 10%. So once I got interested in this sector, I kept on looking YouTube videos after videos for getting a complete grasp of analysis of banking stocks. What are the important factors for bank valuation? But I couldn't find any comprehensive video doing an analysis of this sector. And that is why you should completely watch this video till the end. For banks, the most key parameter to compare is its price to book ratio in conjunction with return on equity. I have selected 15 banks for my initial analysis. So starting with the first parameter, price to book ratio. You may be knowing that book value per share is what you get if you divide total shareholders equity by total number of outstanding common shares. But what this book value represents is how much the company is worth today. That is, if the company sold all its tangible, remember tangible assets, and paid all its liabilities, what is remaining, that is book value. Price to book value is generally greater than 1 because the market value of equity often contains that intangible assets such as brand, intellectual property, etc. So market value is more compared to book value. Price to book ratio is used in banks and not price to earning ratio. Banks have a unique business model compared to other industries. So the asset of a bank are the loans it issued to the customers because they earn money from it. And liabilities of the banks are deposit collected from the investors as they need to be returned to the customers at some point of time. Banks do business with these assets and liabilities. So book value is assets minus liabilities. So the bank do business with this book value and growth of the bank depends on the book value. Plus any bad debts, NPAs, etc. would reduce book value and it is accounted in this matrix. Price to earning ratio is not used. Banks' earning depend on a lot of factors and it is very volatile. A bank is supposed to put aside some provisions for NPAs, that is non-performing assets, every quarter. While the provisions are stipulated as per regulation, there is scope of some movement across quarters. Earnings may fluctuate depending on that. So price to earning ratio is not used for bank comparison. As we have clarified our basics, we will come to our topic of discussion. Looking at price to book ratio and return on equity, I have shortlisted 10 banks where return of equity is above 14 and price to book ratio is less. I have selected DCB Bank which is not meeting this criteria because it is being highlighted a lot recently in news channels, etc. When I refer to an RBI report on trends of banking, they have used return on assets as a measure for banking profitability. So why shouldn't we use it? Let us check this aspect. See the table and DCB is having the lowest return on asset. We will include the next important parameter, that is net interest margin. Net interest margin is a measure of the net return on the bank's earning asset. Banks' earning assets include investments, securities, loans, and leases. Net interest margin is the ratio of interest income minus interest expense divided by earning assets. So, after filling out these net interest margin figures, I was surprised to see the results. I thought HDFC will have the highest net interest margin. Contrary to that, HDFC had the lowest NIM. And Ujjivan Bank, which I don't even think as a worthy contender, has got the highest net interest margin. Later, I realized that HDFC Bank's numbers are not comparable as its merger with HDFC Limited was completed on July 1 this year and it may take a year to stabilize. And for Ujjivan banks provide more than 50% of their credit as microloans to low income individuals and groups. So Ujjivan Bank really deals with riskier business. They charge higher interest rates on these loans without any collaterals. So Ujjivan enjoys such a high net interest margin. Most of the banks in this list are having a net interest margin in the range of 3 to 4. I always consider profit as the most important parameter. So why shouldn't I check the net profit margin? Here I found that Kotak Mahindra Bank is having the highest net profit margin, followed by ICICI. This was again another surprise because Kotak Mahindra Bank was not even in my consideration. Rest all the banks are having net profit margin in the range of 14 to 25%. Here DCB Bank is an outlier with 9.71%. So I am dropping this bank as ROA is also less and net profit margin is also less. Banks get cheap capital from deposit and earn money from the advances. Hence I decided to compare deposit growth rate and advance growth rate. A high deposit growth rate may not be very favorable for the bank because if banks gets an unusually high deposit increase, the money may be less sticky and it may flow out easily at the time of any crisis. So here basically I am looking for any outliers in these ratios. Most of the banks' deposit and growth rates are comparable and are between 10 to 20%. Union Bank of India is an outlier with low deposit and advanced growth rate. Ujjivan is having very high rates, but it can be justified by being a very small bank compared to others. Next, we will move to capital adequacy ratios. Capital adequacy ratio ensures that the bank have a large enough financial cushion to absorb any reasonable amount of losses before they become insolvent. There are two components for capital adequacy ratio. Tier 1 capital refers to a bank's core capital which it uses to run its day-to-day operation. This category includes things like retained earning, common stock, etc. It does not include money deposited by customers. Tier 2 capital is a secondary supply of funds available from sale of assets once a bank closes down. I am comparing Tier 1 capital ratio as it constitutes major part of capital adequacy ratio. Financial regulators use this ratio to determine the soundness and stability of the financial system. So higher tier 1 capital ratio means it is better able to withstand any financial troubles. As per RBI report in 2023, public sector banks, that is government banks, were having tier 1 capital ratio of 13% and private banks are having tier 1 capital ratio of around 16.6%. In our analysis, we can see the public sector banks like Union Bank of India, SBI and Bank of Baroda are having lower tier 1 capital ratio compared to private banks. So we will move to next important parameter which is non-performing assets. It is important for the banks to keep track of their non-performing asset because too many NPAs will adversely affect their liquidity and growth abilities. NPA means loans or advances issued by banks and the borrower have failed to make the payment on principal as well as interest on the loan for at least 90 days. So there are types of non-performing asset, net NPA and gross NPA. We are taking into consideration net NPA because net NPA is the actual loss suffered by the bank. So in this list, we can find that Union Bank of India is an outlier with high net NPA. So I decided to drop this bank, giving us 8 banks in our hand, which are good stocks for investments. I started this analysis by having a bias for HDFC Bank, but look what happened towards the end of the analysis. HDFC Bank doesn't seem to be as attractive as it was in my mind. This is a reason why one should do maximum research before investing your hard-earned money. Kotak Mahindra, ICICI Bank all look equally good candidates for my money, and I am surprised to see the performance of Ujjivan Small Finance Bank. I should do more research on similar small finance bank, and I am planning to do the analysis of these 8 individual banks in the upcoming videos if time permits. A lot of other parameters also determines banks' future performance like investment in technology, etc. I was delighted when I saw the below recommendation from investment banks and asset management firms. So my analysis is matching with what global investors are thinking. I would like to add a few more data. Why financial sector is a good bet for future. I have referred extensively to a report on trend and progress of banking in India 2022-23 published by RBI as well as interviews by various banking heads. What I found out as the growth drivers for Indian banking system are, first thing is that the penetration level of any kind of financial product in India is the lowest among the world. It is not the lowest, it is amongst the lowest in the world. For example, mortgages today are about 11% of GDP. For economies like US or UK or any other European countries, these ratios are well over 40%. Even some of the emerging markets like China, etc. are in 20s. So by this comparison, we are very underpenetrated. Secondly, India has a very young population. Two-thirds of our population is below 35 years of age. People generally buy a house when they are in their late 30s. So there is a massive potential in housing loans because two-thirds of the population is yet to buy house. Similarly, opportunities available in every single financial product. If you look at credit card penetration in India, it is extremely low by global standards. So whichever way, whichever product you look at, growth opportunities exist. Retail credit is fastest growing in India. Retail credits mean housing loans, credit cards, personal loans, car loans, etc. Retail credit to GDP in India is around 80% and it is also very low. But for the first time in recent times, the average Indian, the middle class attitude is changing. They are not averse to borrow money, to consume, to spend, etc., which is very different from what it used to be, say, some 20 or 30 years ago. Thirdly, financial products are very underpenetrated in rural areas. Around 65% of population lives in villages and rural economy contribute to 50% of GDP. But they have only a share of 9% in bank credit and 11% in deposit. So major banks are now shifting their reach to rural areas and aiming to bridge this urban-rural divide. So we have discussed about the opportunities in financial banking sector. What are the underlying threats to banking industry? Recently, the deposit rates of banks have improved. I am getting 7% for an FD now compared to earlier when I was getting around 4%. With this increase in deposit rates catching up with that in lending rate, the profitability of the banks may get affected going forward. Secondly, the share of unsecured advances in total advances has increased. Banks sell unsecured loans in disguise, like top up loans for auto loans, house loans, etc. For the customers, it may be beneficial because they get loans at less interest than personal loans, and customers are lured to take more loans. RBI wants to stop this aggressive loan push to customers and has tightened the capital norms. It has classified top up loans as unsecured loans. It also increased risk weight on unsecured loans like personal loans, credit card receivables, consumer credit, and more such. It will make it tougher for banks to give out loans as easily and freely to consumers. So, banks' growth can be affected. Thirdly, technology is going to be a game changer in future. It helps in inclusion and efficiency by decreasing cost. Recently, I came across an article saying that HDFC Bank top management said that they want to see HDFC as a technology company with a banking license. But there is a bad effect for technology. With the adoption of new technology, the risk of cyber attacks, data breaches, and operational failures also have increased. So, these are some immediate threats for the banking industry. I have tried to analyze the banking sector from various aspects. I'm betting on this sector because opportunity lies in increasing penetration. There are two aspects of increasing penetration. One is penetration in rural areas, unbanked areas where banking is yet to reach, and secondly, I see an opportunity to increase financial products per person. And we Indians are now embracing consumerism like Westerners. I have seen many of my friends taking loans to buy a product first and earning money to pay it later. You can also do your own research and make investment decisions regarding investment in this sector. I hope you have found this video informative. I would be glad if you can share your views about the content as comments so that I can make necessary improvements. I will be super excited if you can share my views with your friends and families and help them in making better investment choices. I hope you all will subscribe to my channel to get more related contents. See you in next video. Stay tuned. Bye.